Hello everyone and welcome to this presentation on the CFA Level I exam for June 2014. In this presentation, we'll look at the financial reporting and analysis section of the exam, reading 26, which is understanding balance sheets. This is the first of two videos that I'll be making on this topic. In this presentation, we'll focus on parts of learning outcome number 5. This outcome talks about the different types of assets and liabilities and how they are reported on the balance sheet. The focus of this video will be to look at some non-current assets, also known as long-term assets, and we'll look at property, plant and equipment, investment property, and intangible assets. In the next video, we'll look at goodwill and financial assets. Let's start by looking at property, plant and equipment. These are tangible assets that are used or expected to be used for a long period, which means more than one fiscal period. For example, auto companies like Ford and General Motors have these factories that they use for making cars. Those factories will be example of property, plant and equipment. Some other common examples are machinery, buildings, and land. Now, how do we report these property, plant and equipment on the balance sheet? Well, that depends on whether we are using the IFRS or the US GAAP. Under the IFRS, we have the cost model or the revaluation model. The US GAAP only permits the cost model. Let's take a look at the cost model first. In this model, the plant, property and equipment is reported at amortized cost. Amortized cost is equal to the historical cost minus accumulated depreciation minus impairment. Now, what is historical cost? Historical cost is simply equal to the purchase price plus any other cost incurred to bring that asset to its intended use. For example, suppose we bought a machine for $950,000 and we had to pay $50,000 for delivery expenses. The historical cost for this asset will be $1 million. Depreciation. We looked at depreciation in the previous reading, in reading 25, where we saw that it's a method for allocating the cost of using the asset over multiple periods throughout the asset's useful life. For example, if this asset costing $1 million had a useful life of 10 years and we expect it to be worth nothing after 10 years, and we use a straight line method, the annual depreciation expense reported on the income statement will be $100,000. And finally, impairment. Impairment is simply any unanticipated decline in value. It's different from amortization. For example, let's say this asset that we bought for $1 million had some physical damage due to an accident. That will be an example of impairment. Now the question is, how do we check whether the asset is impaired or not? The curriculum focuses on the IFRS method for computing impairment. Under this method, an asset is said to be impaired if its recoverable amount is less than its carrying amount. Carrying amount is simply the book value of the asset. It's the value of the asset reported on the balance sheet. But what's recoverable amount? Recoverable amount is the higher of an asset's fair value less cost to sell and value as in use. So it's the higher of these two amounts. Fair value less cost to sell. That's the amount that we expect to receive if we were to sell this asset to a third party, to an unrelated party that was knowledgeable and willing. That's fair value, and then we just deduct the cost to sell this asset. And that will provide us the fair value less cost to sell. Value in use, in the other hand, is a discounted cash flow analysis. It's the present value of the future cash flow that we expect to receive from this asset over its life. Let's say the fair value less cost to sell was $100 and the value in use was $80, and the amount on the balance sheet for this asset was $150. Since the higher of these two is the fair value less cost to sell, and this is less than the carrying amount, the asset will be said to be impaired. Now, any impairment losses are reported on the income statement. If we want to reverse any impairment loss, we can only do so under the IFRS. Now that was the cost method for reporting PP&E. Let's look at the second method, the revaluation method, that is allowed only under the IFRS and prohibited under the US GAAP. In this method, the PP&E is reported at fair value less accumulated depreciation. We just saw what fair value meant. Now under this revaluation method, any changes in the fair value of that asset may have to be reported on the income statement, or it may flow directly to shareholders' equity, depending on the situation. Notice that fair value often changes over time, whereas historical cost is fixed. The second type of long-term assets that we'll look in this reading is investment property. These are the assets that generate rental income or are expected to result in capital gains. This is the IFRS definition. A common example is used in the context of real estate companies that own rental units. The concept of investment property is not defined in the US GAAP. In this method, the investment property can be reported under the cost model, which is absolutely the same as the model for plant property and equipment, or investment property can be reported at their fair value. Now, if you use the fair value model, then any changes, any gains or losses from the changes in fair value are reported on the income statement. They do not flow directly to shareholders' equity. Now let's move on to the third and final type of long-term assets, intangible assets. These are identifiable, non-monetary assets that lack physical substance. Non-monetary means that securities such as stocks and bonds are not intangible assets because they're monetary. Some common examples of intangible assets are patents, copyrights, and trademarks. Now, intangible assets can be acquired through third party or from third party, or they can be created in-house. Under both the IFRS and the US GAAP, acquired intangible assets are generally reported on the balance sheet, whereas internally created intangible assets are usually expensed on the income statement and they are not reported on the balance sheet. Let's take a closer look at internally created intangible assets. Under the IFRS, all the research costs that are incurred to develop these intangible assets are expensed. but the development costs are capitalized if certain criteria are met. For example, the project is technologically feasible, or there's ability to complete the project and the resulting asset can be used or sold. On the other hand, the US GAAP requires most R&D costs to be expensed. Therefore, under the US GAAP, the development costs won't be capitalized even if all of these criteria are met. Now, how do we report intangible assets on the balance sheet? Again, it depends whether we're talking about the IFRS or the US GAAP. The IFRS allows for the cost model and the revaluation model. The revaluation model is only used if an active market exists for the intangible assets, whereas the US GAAP only allows the cost model. Now, these models are pretty much the same as the models that we used for plant, property, and equipment. Now, how the intangible assets are reported in the balance sheet is influenced by the fact whether they have finite lives or whether they have indefinite lives. If the intangible assets have finite lives, then they're amortized and tested for impairment, just as what we do to plant, property, and equipment. And at least every year, we have to review the amortization method and review whether the useful life assumption is still valid. On the other hand, when we look at intangible assets with indefinite lives, they are not amortized. They're not amortized because there is no concept of useful life. The useful life is infinite. But every year, we are required to test for impairment and review whether it is still reasonable to assume that the life is actually indefinite. Now, this brings us to an end to this presentation. If you found this video useful, please make sure to subscribe and leave comments. Thanks very much for watching, and I wish you the best of luck for the exam. Thank you.